Welcome to week 3. I'm back in Midland now, so I'm upping my game with a little better production quality. I'd love to hear your feedback on it. We've had a really good start on the discussion boards. I can't believe the volume and quality of the comments and responses. I hope that you're starting to notice that you're thinking differently about finance concepts. If you are, I'd love to hear about it. Let me know how my participation worked for you, particularly last week. Was it too much, not enough, or just about right? I will have your grades and my feedback for discussion number 1 by Tuesday. This week we are finishing up looking at the balance sheet by taking a deeper dive into liabilities and equity. Equity is also known as net worth, stockholders or owner's equity, and in the nonprofit world, net assets over liabilities. For the discussion board, I'd like you to think about your company or one that you're familiar with or one that you would like to start someday. Discuss how this company is or will be funded. What combination of payables, loans, bonds, and equity will be or are used? Where does the equity come from? How does the funding model change over the life cycle of a company? We're also going to take our first look at the income statement. As I said last week, you cannot look at the balance sheet in a vacuum. Well, the same is true for the income statement. There are connections that are important to understand when you review both. If we look at the balance sheet as a point in time, we can compare it to a photograph or a snapshot. It tells a story that only lasts for a moment. On the other hand, the income statement is a story that represents a time period. So we can compare the income statement to a movie or a video. Remember, when we talk about accounting periods in this class, they can be a day, a week, most likely a month, quarter, or a year. The income statement describes the revenues and expenses over that period that results in income. Be precise when you refer to the top line as revenue and the bottom line as income. People use these interchangeably, and in my mind at least, they're very different. Let me see if I can help you understand the relationship between the balance sheet and income statement without getting into the weeds too much. Here's a very simple balance sheet and income statement. To keep it really simple, we won't even assign any values to the accounts. Notice that the assets plus liabilities, or assets equal liabilities plus equity. Our assets are comprised of cash, accounts receivable, and fixed assets, things like equipment and buildings. Our liabilities are accounts payable and loans. What's left over is equity. On our income statement, we have revenue less cost of goods sold equals gross profit. Less sales, administrative, and general expenses gets you to operating income, and then if you subtract out other income and other expenses, you get to income before taxes. We have to pay the government, and then you end up with net income, or sometimes called just income. Let's take a look at a couple of transactions to see how the balance sheet and income statement are related. Let's use a car dealership as an example. Before we can make a sale, we have to purchase inventory. We get that from the manufacturer, and we don't have enough working capital or cash available to really pay for all that inventory. So we take out a loan from the bank, and we credit the liability and debit the inventory. Customer comes in and buys a car. We increase our revenue and take a down payment and a payment plan for the car, so both cash and accounts receivable increase. At the same time, we debit cost of goods sold and credit inventory to account for the cost, not the price, but the cost of the car. A few days later, the sales person is looking to get paid, so we pay them their commission by debiting sales and administrative expenses and crediting cash. If we do this more than once in an accounting period, this process would be repeated. In the meantime, we are accumulating other expenses for sales and general administrative. We also have to account for things like depreciation on the equipment, and that creates a debit for expenses and a credit against fixed assets. You hope that revenue is higher than all the expenses and taxes at the end of the period, and the leftover is net income. When you close out the accounting period, that net income gets added to equity, and if all went well, your balance sheet should balance. There are 1,000 of other things that went on in the background that we don't have time to discuss right now. But the takeaway, and something that you should keep in the mind as you read this week's materials, is that the Balance sheet and income statement are presented separately, but are very much connected. I want to finish up by giving you some direction on the balance sheet detective assignment. You'll need 2 documents to complete this. First is the case study found in the course pack. Second is the worksheet that you will find under course materials. The idea is to review the balance sheets that are presented in what we call common size format. That means they are all formatted as a percentage of total assets. This is so that you can compare one company to another despite their size. There are 9 companies with a short description and 9 balance sheets. Your job is to match them up. More importantly, I want you to provide 2 clues that help you identify how to match the company with the corresponding balance sheet. I'm grading correct matches as 30% of the total grade and the description of the clues that you used as 70%. I am more interested in what you are thinking as opposed to getting the right answer. Let me give you one example of what I'm looking for. As you see in the case study, Google has a high level of cash due to their recent IPO, and they have good cash flow from operations. They have low plant property and equipment due to being pretty much a service business. You might think they'd have high intangibles, but due to the US GAAP guidelines, they cannot recognize the high brand and process equity on the balance sheet. If you look at a balance sheet that matches these criteria, balance sheet F matches up the best. I'm feeling good about the way this class is going so far, and I hope you are too. I'll see you on the discussion board.